The gig economy platform Fiverr International is scheduled to report third quarter 2024 financial results on October 30th. That has investors asking if they should buy Fiverr stock before that date. I'll answer that question in this video. I'll also preview what investors should look out for from Fiverr in the upcoming earnings release. And as a reminder, Fiverr has been one of my top recommended stocks to buy here in 2024. It's been one of my worst performing stocks on my list of top 25 stocks to buy in 2024. So is a turnaround on the mend? I'll answer those questions and a lot more in this video. Let's get into it. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so one of the bigger trends in the industry is an increase in the take rate. What does that mean? Let me elaborate. So Fiverr, as I mentioned, is a platform that attracts those that have gigs or services they want to provide, and it matches them with businesses or entrepreneurs that have tasks that they want to have completed. Fiverr brings those two sides together and takes a fee from each transaction. That fee is called the take rate. So if somebody spends $100 on Fiverr platform, they will pay, or the person that earns that $100 will pay a roughly 30% rate to Fiverr for maintaining and keeping up the platform. So it's a lucrative business model, this platform business model, and I have several stocks that operate on this business model that I have recommended as a buy or a top stock to buy. And some of those off the top of my head include Airbnb, eBay, Upwork, and there's more that I've recommended. Uber is another one that I've recommended that operate this platform. The platform business model is lucrative because the business doesn't have to spend very much capital on whatever it is that's being sold on the platform. It's the people, like the gig economy providers, that are putting up the services, putting up the capital to provide those services, right? These individuals are buying their own computers, they're subscribing to software to enhance their service capability, they're giving up their time, they're the ones that are communicating with the buyers, trying to facilitate sales. So they're doing a lot of the hard, heavy lifting for Fiverr, and Fiverr just gets to take a percentage of each transaction. Needless to say, I'll remind everyone, I like this business model, and it's one of the prime reasons why I recommended Fiverr. Now, one additional benefit is the increasing take rate. So the business model itself, a lucrative business model. And then another thing I look at, if you've read my book, my 6-step framework for investing, buying and selling stocks, one of the things that are an important factor is competition. And in this industry, competition is easing. And what do I mean by that? Well, Fiverr just says that they're increasing the take rate. Upwork has been doing the same thing. They've been increasing the take rate. And many other businesses that are in a similar, I think, supplemental field are also increasing the take rate. So that's beneficial because that increases profitability industry-wide. That makes it more attractive for investors when businesses are saying, oh, you're raising price? We'll raise price too. You're raising price again? Let's raise prices too. All the while, profit margins are increasing and customers are looking around and saying, well, it doesn't matter where we go, they're all raising their prices, so we might as well just stick around. And that's great for investors. Fiverr went on to say in their latest quarterly results that they are raising the bottom end of their full year guidance for both revenue and profitability to reflect the recent updates. So the start in 2024 is better than the company expected, and so they're raising their target for revenue and profitability for the year. Now, it wasn't all great news for Fiverr. I mentioned earlier that the company is raising the take rate, and one of the things that happens when you raise price is demand decreases. That's true in nearly every category. Prices go up, demand goes down, and that's what Fiverr saw. But overall, it was still positive. So let me share that with you. Active buyers, 3.9 million, was down 8% year over year. Now, this is partly a result of the increasing take rate and partly a result of industry trends where small business creation, small business spending has decreased. But every time you have price increases, consumer demand typically falls. And that's true in this case here as well. But overall, you evaluate, was that still beneficial? And the answer is yes, right? Revenue still increased by 6% year over year. So even though they saw some customers leaving, overall, because each buyer was spending more, 10% more year over year, and the increasing take rate, 230 basis point improvement year over year to 33%, that offset the decrease in the number of active buyers to drive revenue growth. And overall, Fiverr's strategy is to focus on more profitable customers, not just going after any customer. And so that is something that I also appreciate from a management team. Focus on customers that you can serve profitably. Don't just go after every single customer. And overall, that I think was a prudent decision, even though they did experience a decrease in active buyers, which is not very good. So looking ahead, what should investors expect from Fiverr? Well, they said for the third quarter 2024, expect revenue growth of 4% at the midpoint, and for the full year to expect revenue growth of 6.5% at the midpoint. This was up from their previous guidance of 5 to 7% at the midpoint. So Fiverr has consecutively increased their guidance for the year, slowly lifting up the annual revenue target. And every quarter they've delivered better than expected revenue so far in 2024. And it's the same for the bottom line. I shouldn't say bottom line, but adjusted EBITDA, one metric for profitability. They raised that target for 2024 from a range of 67 to 73 million to a range of 69 to 73 million. So at the very least, they expect 69 million in adjusted EBITDA. That was up from 67 million. So, incrementally better than what the company was forecasting. And that's what you like to see, right? How often do you see companies that are over-promising and under-delivering? Fiverr has been doing the opposite. They've been under-promising and over-delivering. I don't recommend that either. I prefer management teams just to try to be accurate with their forecast. Don't try to be conservative like Fiverr has been, and don't try to be too optimistic like Tesla has been, where you consistently over-promise and under-deliver. And don't do the opposite either. Don't consistently under-promise and over-deliver. Try to be accurate so that me as an analyst, I can use your predictions. I don't have to make adjustments to your predictions, trying to second guess you and say, well, you're usually conservative. So when you say 4%, do you mean 5%? Or when you say 6%, do you mean 8%? I don't want to have to play that guessing game. Just tell me accurately what you think your numbers are going to be, not trying to be one way or the other. They continue to say that they are generating impressive cash flow. CFO from operations was 21 million. And if you compare that with total revenue of 94.7 million, you'll notice that they generate strong cash flow from operations to sales. And again, this points to the lucrative business model that generates strong cash flow because they don't need to spend so much into the business all the time. The business model itself is lucrative. They just bring together two sides of the equation, and those two are the people that are spending the time and money to generate revenue and cash flow for the business. Now, they speak to some of the headwinds they're facing. The overall hiring environment remained challenging. U.S. job openings were down 7% year over year, and job openings in the information sector specifically were down 17% year over year. Professional Staffing Index, which tracks temporary hours, was also down 7% year over year in June compared to 6% decline in 2023. And this coincides with the trends that I've been seeing industry-wide, that this sector is experiencing a decrease in spending as businesses have tried to do more with less. And the area they're spending more money on is the hardware and software for artificial intelligence. And they've been cutting back in other areas to make room for spending in that category. However, this is a short-term trend. Longer term, this gig economy platform is much more convenient for many businesses than hiring somebody full-time right at the onset, right? Maybe you start to feel the need for additional help for your business. And instead of just going right away and hiring somebody full-time, you can go on the gig economy platforms like Fiverr and hire somebody to do these tasks for you, maybe for a couple of weeks, and you test them out. And if they prove to be someone you want to onboard full time, you can do that. Or you can just employ them through the gig economy platform and make it much more convenient. You don't have to do all the human resources work to onboard an employee and all of the implications that comes along with that. So longer term, I think there's a tailwind for this business. And then, of course, the biggest risk factor that investors have feared with Fiverr is artificial intelligence and how it's going to impact the business. But Fiverr keeps saying that we believe AI will be a net benefit for the company. Even though some jobs will be eliminated, others will be created on the platform, and the offsetting factor will be positive, net positive for the business. AI remains very early in its evolution, and it's clear to us that by providing businesses with access to AI talent and services on a trusted marketplace, it's a massive opportunity globally, and we intend to lean into it. And I agree with this statement from management. I think that the people on the platform are going to be using artificial intelligence, and so their services will be enhanced and more attractive to entrepreneurs looking to hire talent. Or they can complete the same amount of work in less time, and so they can offer their services at lower prices, again, making it more attractive to entrepreneurs looking to hire people on the platform. Overall, I do think it will be a disruptive force, artificial intelligence, but I agree with management in that it'll be a net positive for the business. I mentioned Fiverr has been one of the worst performing stocks in my top stocks to buy list. It's trading at $21 per share right now, down from around $26 where it started the year. But I think the stock is ridiculously cheap at a forward price to earnings of 8.33. If you've been watching these videos, I typically do not advise buying a stock ahead of an earnings release, except in some rare situations where I feel the company's stock is undervalued meaningfully. This is one of those cases where I feel the company is so undervalued, there's enough margin of safety to buy this stock ahead of the earnings release. I feel there's more upside risk following the earnings release than there is downside risk for this business since it's already so cheap, trading at a forward price to earnings of just 8.33. So to answer the question, should you buy this stock before earnings? I say the answer is yes. This is one of my top rated stocks to buy. It's so undervalued that the reward versus risk is in your favor going into the quarterly earnings release. And I would say that this is an excellent opportunity for long-term investors to benefit from this trend. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.